Good morning. Common lending mistakes CRE investors make. Commercial real estate financing is rarely simple, and small mistakes at the loan structuring stage can cost investors hundreds of thousands of dollars over the life of the deal. And from choosing the wrong loan product to misunderstanding lender underwriting priorities, these errors often surface later in the process when options are limited. And as a mortgage broker working across banks, agencies, CMBS lenders, and private capital, I see the same lending mistakes repeated again and again. So let's have a talk about those, and below are the most common commercial real estate lending mistakes and how smart investors can avoid them. Number one is choosing the loan based on the rate alone. Interest rate is only one component of a commercial loan and often not the most important. Some other common issues that you might clue in on are ignoring prepayment penalties or yield maintenance or defeasance that comes along with that offer. You could be overlooking recourse exposure, and you could be selecting short-term debt for longer-term assets, which means you could be missing flexibility for future refinances or sales. And a slightly higher rate with better terms often produces a stronger long-term outcome is the takeaway. Two is not matching the loan structure to the business plan. And consider a value add deal, stabilized property, and owner occupied acquisition all require different financing strategies. And mistakes can occur when investors use permanent debt for transitional assets or use bridge debt without a clear exit. Or if you underestimate seasoning requirements for takeout financing. So your financing should support your timeline, your risk tolerance, and your exit strategy, and not work against it is the point. Three is underestimating DSCR and cash flow requirements. So many investors focus on purchase price and loan to value while overlooking debt service coverage ratio or DSCR. And lenders care about net operating income sustainability, stress tested cash flow, market vacancy assumptions, and over leveraging a deal often leads to reduced proceeds, higher pricing, or declined loan latent underwriting. And four is poor financial documentation preparation. This one's the most avoidable. So incomplete or inconsistent documentation slows deals and weakens borrowers' credibility. And you don't get more than one chance at a first impression. So some common mistakes are outdated or mismatched rent rolls and P&Ls, or missing entity documents, or unexplained income or expense anomalies. Could be weak personal financial statements for the guarantors. And the point is that well prepared financials signal professionalism and reduce lender friction. Number five is ignoring recourse and guarantee language. Not all non recourse loans are truly non recourse, and investors are often surprised by bad boy carve outs for fraud, or environmental or other fraud triggers, partial or burn off recourse structures. And the point is, understanding guarantee exposure before signing a term sheet is critical to your risk management. And number six is waiting too long to involve a mortgage broker. And many investors approach lenders directly without understanding how capital markets price their risk. And as a mortgage broker, I can shop multiple lenders simultaneously for you, eliminating a lot of friction and simplifying the process. But it also structures leverage and terms strategically. And we can anticipate underwriting objections early in the process. And we can also align the loan with your future refinancing options. And early involvement is going to create leverage for you, not cost. And number seven is assuming all lenders underwrite the same way. And they don't. Banks, agencies, CMBS lenders, and debt funds each evaluate risk differently. And some of those differences can include how your income is calculated, how they treat your tenant rollover and your rent rolls, and if they have certain market concentration limits, and also their appetite for specialized assets. And understanding lender psychology is just as important as understanding the numbers. So here's the final takeaway. Commercial real estate lending mistakes are rarely fatal, but they're expensive. And the best investors treat financing as a strategic tool and not a commodity. And proper loan structuring preserves equity, improves returns, and protects flexibility in changing markets. So if you're buying, refinancing, or repositioning a commercial property, the right financing strategy can be the difference between a good deal and a great one. And that, my friends, is it for the day. Please visit Bill Rapp online to figure out how to get a hold of me, and I look forward to chatting further. Have a good day.